Good day and welcome to another STANLIB Asset Management podcast. My name is Stephen Backhouse, Head of Retail Strategy at STANLIB Asset Management. And today I am chatting to Eulali Gouws, our Head of Money Markets at STANLIB Asset Management. Welcome, Eulali.
Thanks, Steve. Happy to be here.
And today, yesterday, the SARB had a decision on the interest rates. So we are talking about the repo rate, and actually the decision was that the SARB surprisingly kept repo rates on hold. And today we talk about what this means for your money market investments with STANLIB. Before we get going, just quickly, Lolly, you recently became a mum end of last year. So a beautiful little girl, Lily. How's motherhood treating you? How's Lily?
Steve, just fantastic. Motherhood has been the most rewarding and challenging experience of my life. My baby girl's face is just the most beautiful thing I've ever seen, and she lights up every room. And I mean, I say that I've done challenging things, but waking up at 2 a.m. is tough.
It's amazing how one learns to function on a little sleep. Beforehand, you kind of think that never, but now you actually, it's amazing how you can keep going.
Now it's part of life.
Just getting into the proper conversation today. So I mean, Lolly, at the beginning of 2026, the market and yourself and STANLIB, we were expecting a couple of interest rate cuts actually this year. But fast forward 6 months, a lot has happened, and we've actually had a rate hike. And yesterday's decision of keeping rates on hold was actually a surprise. We and the market were expecting an increase in interest rates. So, I mean, first of all, what has changed over the last 6 months?
Well, Steve, to sum this up into one short answer is the war in the Middle East. The uncertainty the war created, together with the spike in the oil price, has had a significant effect on markets. Prior to the breakout of the war, inflation was contained and actually at the target of 3%, which meant that we expected rate cuts, as you mentioned. But since then, we have seen inflation move to 5% in the most recent print due to rising transport inflation and elevated housing and utility costs. Given these upside risks to inflation, the Monetary Policy Committee had to make a move and start hiking rates. To point out, we have not moved into a rate hiking cycle. The rate hike we had was just precautionary. And when the war stops and the oil price stabilizes again, we can move back into the interest rate cutting cycle. This is further justified by the fact that we didn't see a rate hike yesterday, as the committee sees the policy stance as appropriate for now.
Okay. I mean, so in terms of someone like myself who's got a bond, rates going up is not necessarily a good thing because I've got to pay more on my bond, on my home loan. But for clients who've got money invested in money markets, an increase in rates is actually a positive. But at the moment, you say we're on hold, and actually if the sentiment changes, then we actually might go into kind of rate cutting cycle. What are the different cycles, and what do those mean, particularly kind of a rate increase cycle, which we're not in, mean for our clients?
So it depends on how the money market fund you are invested in is positioned. So given the recent market dynamics, we have positioned our funds conservatively so that they are ready to adapt to a rate hike and also can give you a return if we're on a hold. Because remember, you invest in a money market fund almost to hedge yourself against that bond you have, that home loan you are paying off. So the floating rate assets in the portfolio that we currently have in the retail money market fund are linked to Zeronia. So Zeronia is the replacement benchmark for JIBAR that ceases to exist at the end of this year. What this means is Zeronia actually adapts immediately if we see a rate hike, and it also trades in line. So if we had a hold, you still earn that rate that you have seen. But if there's a rate hike, your rate on your investment will almost adapt immediately because your reference rate will follow the market. And you'll see that is an increase in your portfolio return without a delay, almost like you've had in JIBAR. With JIBAR, there used to be a delay Now it's a nice quick step in, but unfortunately reverse is also true. So if the inflation is contained and we move into a downward interest rate cycle again, because the rand is strong, inflation is at 3%, then your portfolio will unfortunately follow suit and start declining as well. But then we also try and be more creative with some fixed rate instruments to try and still get you that good yield in the portfolio.
Okay. And how does this compare to, say, like a bank fixed deposit?
So with a bank fixed deposit, you are exposed to one bank and probably locked in for a set period and at a fixed rate. So meaning that you can't get your money before the term of the fixed deposit mature, and the rate doesn't adapt to changes in the repo rate. If you're invested in a money market fund, your exposure is diversified over a range of counterparties, and the cherry on top is that you can get your money on the same day and your rate adapts to movement in the repo rate, meaning you can withdraw at any time, have your cash on the same day, and earn a rate that is competitive to any short-dated investment in the market.
Okay, let me say, so simply put, is that if I've got money invested in the money market, I can access it. The liquidity is almost immediate, so I can have it straight away. But I also get the benefits of being in these kind of potentially longer dated type fixed investments, and I've got my counterparty risk, which is kind of risk to different types of institutions, is a lot broader. So I'm not necessarily taking a bet on one large business, which potentially not that they go bank, but if something did go wrong, then I don't have that pain essentially.
Absolutely.
Okay, cool. Yeah. I think that's probably about it. Hopefully that gives our clients enough to think about and feel comfort in terms of their money market investment, and that they are in the right place. So I think, first of all, Eulali, thank you very much for this very insightful conversation and your time. Really do appreciate it. Always a big thank you to the audience for taking your time out to listen to us. And if you need more information about STANLIB Asset Management, please feel free to visit our website, www.stanlib.com. Where you can find a lot more insightful articles, podcasts. I think there's some webinars and things on there. And if you've got any questions, please, feel free to reach out. And hopefully you're happy where you are. Okay. Thanks very much and appreciate it. Thank you, Eulali.
Thanks, Steve.
STANLIB Asset Management Pty Limited is an authorised financial services provider in terms of the FAIS Act. This podcast should not be construed as advice.